Hello and welcome to today's video, which is called S&P 500 at 200-day moving average. Oops, rejected. But you did not expect we would get through this resistance at the first attempt, did you? Let's examine the situation objectively, where equities stand, sectors, individual strength, and derive appropriate conclusions of where we are headed today on the day of GDP and unemployment claims. Such was the situation yesterday. Pre-market, very encouraging pattern of slowly rising prices, higher highs, higher lows. However, the situation following the opening bell clearly deteriorated, and in the latter half of yesterday's session, I have sent this chart to clients, talking about first 5777 support level, which was the modest one, and I did not favor a break below 5760s, low 5760s, which was incidentally the resistance level that I had identified following FOMC that had stopped the bulls on Thursday last week. So where do we stand right now as prices had drifted lower? Micron earnings did not support risk-taking at all. However, we had seen quite some encouraging signs within what can be still either a dead cat bounce, continuation before further downswing, or rising through 5760s again to the upside. Let me just say that the expectations heading into unemployment claims and GDP are leaning very negative, and it's not totally justified that they would be that negative in the market reaction to the actual figure. Obviously, the daily gap, it's a matter of contention whether we feel it or not. Market breadth indicators are quite inconclusive. Volume as well shows that not enough buyers have appeared yesterday. However, we are shaping up for a slightly positive open today, and let's refine the picture through the percentage of stocks trading above various periods of moving averages. This hints still at ongoing rotation, as we will see further from the sectoral charts that I'm bringing you. Thank you for liking this video and subscribing to the channel. Turn notifications on so as to be notified whenever new content goes up. So, we are seeing quite sideways, quite consolidation, and it would be too early to call it as a definitive rejection at the 200-day moving average. Further clues follow through sectoral perspectives. Sure, yesterday was a risk-off day. We had seen tech, discretionaries, and communication services leading to the downside. Financials have kept relatively well, and the same is true regarding industrials. So this is a little bit mixed picture. Remember that semiconductors are not looking appealing, and this is one of those charts that I'm presenting you in today's packed video further on. Nvidia, semiconductors, Micron, no shortage of bad news. Microsoft cutting on CapEx, OpenAI. Little wonder that utilities have taken a relative breather, because there are distinct fears of oversupply in data center and associated equipment, which of course influences margins. That's why semiconductors are looking this poor and they are losing altitude through multiples being taken down a notch or two. So let's step back and evaluate the 5-day perspective. It's showing precisely what I have been just saying regarding utilities. Defensives are not doing great. However, communications and the turn in Tesla as well, which is not really rolling over to the downside from here, and it could very reasonably stop in the high to mid 260s before powering higher again. This is not a picture of risk off on a 5-day perspective, not really. The reasons for weakness we had already covered, and industrials being so neutral is not a bad sign either. You remember my points regarding financials, and they are still doing okay, and that's the sector I count on the most. Pretty ugly semiconductors chart, rising volume, and the way it's shaping, it's technically said ugly. Nasdaq a tad better, also aiming for the possible gap closure. However, the volume perspective is not all that bad, so there is a little bit, a very weak glimmer of hope, very weak. Remains to be seen what equities do later on today in the aftermath of the reaction to data. Financials, very best looking chart, no reversal. This is at best, at worst, going to be a sideways consolidation, and I do have confidence that this sector is in for a good period, good couple of trading days, more than that. Still, industrials lagging but not breaking down either. Of course, it's very tough for financials alone to power the stock market rally. However, I do count on different other sectors to help it along and cushion the downside. US dollar, why is it down right now? Does it have to do anything with Bank of Japan and yen carry trade unwind fears? No, absolutely not. Those fears I have been telling you practically every other week that they are quite overblown, and it's not on the table for the Bank of Japan to normalize policies, no matter what inflation does, no matter how badly Japanese wages are lagging behind. It's not on the table, and US dollar is still looking in a shallow retracement, trending up, and this is powering inflows into US equities. I've been covering that in the latest videos. Thank you for liking them. My join page will help you select what's right for you based on what and how you trade. I can't stress enough the importance of combining daily analytics together with intraday channels for extras. Intraday, whatever happens, and is worth mentioning. You know my story, obligatory disclaimer, and talk soon again.